You want to get into commercial real estate, but every time you sit down to read a deal memo, listen to a podcast, or talk to a broker, you feel like everyone around you is speaking a different language. NOI, cap rate, DSCR, triple net, LTV, it just keeps coming and nobody stops to break it down. They assume you already know, or they don't want to slow down the conversation, and so you nod along quietly and Google it later. I've been there. Most people in this industry have been there. So today we're gonna fix that. We're gonna walk through the terms and acronyms that come up consistently in commercial real estate, what they actually mean, why they matter, and how they ultimately connect to each other. And by the end of this, you're gonna feel a whole lot better in rooms where this language is every day. So let's start with the most fundamental concept in commercial real estate, and that's NOI, net operating income. You're gonna hear this one constantly. NOI is simply the income a property generates after you subtract the operating expenses. So if a building brings in 500 grand a year in rent and it costs 200 grand to operate through taxes, insurance, maintenance, then the NOI is 300,000. That's the number that drives almost every other calculation in CRE. It's the engine. Now, once you have the NOI, you can start talking about cap rate. Cap rate is short for capitalization rate, and it's basically the return a property produces relative to the purchase price, assuming you paid all cash and had no debt. And that formula is simple. It's NOI divided by the purchase price. So if that same property with 300,000 in NOI is selling for $4 million, the cap rate is 7.5%. Cap rates are how investors compare different properties across different markets and different asset types. A lower cap rate generally means that the market sees the asset as a lower risk or higher quality, and the price reflects that. And then a higher cap rate often signals more risk or maybe a market with less competition. Here's the thing about cap rates that trips people up. They move inversely to the value. When cap rates go down, values come up. And likewise, when cap rates go up, values come down. So when you hear someone say cap rates are compressing, that means prices are rising. And when cap rates are expanding, prices are softening. Once you get that relationship locked in, a lot of market commentary starts to fall in place. Now, let's talk about lease types, because this is another area where the terminology can get a little confusing. You've probably heard the term triple net lease or NNN. This is one of the most common lease structures, especially in commercial real estate, most commonly found in retail and industrial assets. In a triple net lease, the tenant pays not just their rent base, but also their share of taxes, insurance, and maintenance costs. So as a landlord, your income is a lot more predictable, mostly because the variable expenses are passed through to the tenant. And that's why triple net properties are so popular with investors who want stability. You're essentially sitting back and collecting a check every month without a lot of surprise expenses eating into it. Now, on the other end of the spectrum is a gross lease, sometimes called a full service lease. In this structure, the landlord covers most or all of the operating expenses, and the tenant just pays one flat fee every month. This is more common in office buildings. The landlord has more control, but also more exposure to rising costs. In between those two is what we call a modified gross lease, which is exactly what it sounds like. It's a blend of the two. The tenant and landlord split expenses in a way that is negotiated, and you'll see this a lot in multi-tenant commercial buildings and things of that nature. Now, let's talk about some of the financing terms, because this is where a lot of new investors get lost. LTV stands for loan to value ratio. It's basically the percentage of a property's value that you're financing with debt. So if you're buying a $2 million property and the bank is lending you 1.4, your LTV is 70%. Lenders use this number to understand how much skin you have in the game. Most commercial lenders want to see an LTV somewhere in the range of 65 to 75%, which means you're putting anywhere from 25 to 35% as your down payment. The lower the LTV, the less risk the lender takes on. Now, closely related to this is DSCR, debt service coverage ratio. We touched on this in the refinancing video, but it's worth going a little bit deeper here. DSCR measures whether a property's income is sufficient to cover the loan payments. The formula is NOI divided by annual debt service, meaning basically the total principal and interest payments for the year. A DSCR of 1 means the property is just barely covering the debt. Most lenders want to see 1.25 or even higher is better, meaning the property generates at least 25% more income than it needs to cover the loan. If you're looking at a deal and the DSCR is below 1, the property is not generating enough income to pay its own mortgage. That is a big time red flag. Now, let's talk about a few more terms that come up all the time when you're analyzing a deal or just talking shop. GRM, gross rent multiplier. This is a quick, back of the napkin way to compare properties before you get into the full-fledged underwriting process. It's the purchase price divided by the annual gross income. So a property selling for $1 million that generates $100,000 in gross rent has a GRM of 10. It's a rough tool, not anything super precise, but it's useful for quickly filtering out deals before you spin wheels on them. Cash on cash return is another one that you'll hear constantly. This one measures how much cash you're actually making relative to the cash that you put in. Not the total property value, just your equity. So if you put $400,000 into a deal and you net $40,000 in cash after all expenses and debt payments, your cash on cash return is 10%. This is the number a lot of operators actually care about day to day because it really reflects the actual performance of that invested capital. Now, let's get into a few terms around the property itself. Occupancy rate, pretty straightforward. It's simply the percentage of your leasable space that is currently rented out. If you have a 10-unit building and 8 units are occupied, you're at 80% occupancy. Vacancy rate is the flip side, in this case, 20%. These two always will add up to 100. And when you're underwriting a deal, lenders and experienced investors, they don't just look at current occupancy. They want to know the historical occupancy, the market vacancy rate, and whether occupancy is trending up or down. They want to be able to anticipate what's going to happen before it does. Now, rentable square footage versus usable square footage is a distinction that comes up a lot in office and mixed-use properties. Usable square footage is the space a tenant actually occupies, and rentable square footage includes a proportional share of common areas. Hallways, lobbies, bathrooms, elevators. The difference between those two numbers is called the load factor or the common area factor. So when you're comparing lease quotes, make sure you're comparing the same metric. A lower rate per rentable square foot might actually be more expensive if the load factor is very high. Now, there's a few more acronyms worth knowing before we wrap up. NOI we already covered, but you'll also hear EBITDA, earnings before interest, taxes, depreciation, and amortization. This one comes up more when you're looking at owner-operated commercial properties or businesses attached to real estate. It's a way of measuring the underlying cash earnings of a business before accounting and financing decisions are factored in. If someone is selling a car wash or a self-storage facility, they might talk about EBITDA rather than just the NOI. PSF means per square foot. You'll hear this constantly when talking about rent, value, and even construction costs. A lease might be quoted at $24 per square foot annually, or a building might have just sold for $150 per square foot. It's just a way of normalizing numbers so you can compare properties of different sizes. Now, COE, close of escrow, is basically the date a transaction officially closes. You'll hear this in deal timelines and purchase agreements. LOI is letter of intent. This is the document that comes before the formal PSA or formal purchase and sale agreement. It lays out the basic terms of a deal before both parties commit to full-on contract negotiations. LOIs are generally non-binding, but they set up the framework for everything that follows. And then we've got value add, less of an acronym and more of a strategy, but it comes up so often that it deserves a quick mention. So a value add property is one where the current income is below where it could or should be. Maybe rents are below market, or occupancy might be low, or maybe the building needs physical improvements. The investor's thesis is by fixing those things, they can increase the NOI and therefore increase the value of the property. Since commercial property values are driven by income, this is one of the most common ways that investors create equity. So look, commercial real estate has a lot of vocabulary, and you're not going to absorb all of it overnight. But what I want you to take away from this is that most of these terms are not complicated once someone explains them plainly and you see them play out. NOI drives value. Cap rates tell us how the market prices that income. LTV and DSCR tell us how lenders think about risk. Lease structures tell us who's responsible for what, and metrics like cash on cash and GRM help you quickly evaluate whether a deal is worth your time. The language exists for a reason. It makes conversations faster and more precise once everyone's working from the same definitions. And now you are. So if this helped, subscribe, stick around. We're putting out practical content just like this for people who want to actually understand commercial real estate, not just collect buzzwords, but build real knowledge. Thanks.